Hello, this is Jessica Dunn. I will be re-recording Chapter 1 lecture. Hopefully this one will turn out better than the last. Finance is both a science and an art. It's not like our math courses where everything's based on laws that have been proven. There's no formula saying that if you invest in X, Y, and Z, you will be guaranteed a 10% return. So there's an art component as well. At the personal level, finance is concerned with individuals' decisions about how much of their earnings they spend and how much they save. In a business context, finance involves the same types of decisions: how firms raise money from investors, how firms invest money in an attempt to earn a profit, and how they decide whether to reinvest profits in the business or to distribute them back to investors. So the field of finance answers who owns a company, who controls the company, who holds risk, and who makes a profit. Corporate finance provides managers with the skill that they need to identify corporate strategies and to choose individual projects that will add value to the firm. It also allows managers to develop the skills necessary to forecast their funding requirements and to devise strategies to get those funds. Financial services is the service side of finance. These are service-oriented jobs. And it is concerned with the design and delivery of advice and financial products to individuals, businesses, and governments. Opportunities in the financial services field include banking, personal financial planning, investments, real estate, and insurance. On the action side is managerial finance. Managerial finance is concerned with the duties of the financial manager working in a business, and this is an action-oriented job. These financial managers develop financial plans and budgets, they extend credit to customers, they evaluate proposed expenditures, and they help raise money to fund operations. There are two primary professional certifications within the field of finance. There's the CFA and the CFP. A chartered financial analyst To become a chartered financial analyst, you must take a series of 3 exams. You need 4 years of relevant work experience. To be able to sit for the exam, you have to be in your final year of your bachelor's degree and hold 4 years of work experience. College time does count towards this experience. To become a certified financial planner, you have to have sat through 5 courses. We do offer all 5 at Murray State: Finance 333, Investments; Finance 336, Employee Benefits and Retirement; Accounting 302, Income Tax; Finance 331, Insurance; and Finance 338, Estate Planning. Once you've sat through all 5 of these courses, you're eligible to sit for the exam. You have to have 3 years of work experience to actually hold the title of CFP. So we're going to jump right into the different forms of business organization. First off is a sole proprietorship. This is a business owned by one person and operated for his or her own profit. We're going to go through the strengths and weaknesses. Let me turn my pen on. Strengths. A sole proprietorship is simple. It's easy to start. It does offer secrecy. Unlike a public corporation, these companies aren't required to file mass amounts of paperwork with the government. The owner has control. There are few regulations. And it's not subject to corporate taxation. Of course, there are weaknesses. The owners do face unlimited liability. It's difficult to grow. There are a few avenues of which you can find financing. You're limited to your personal savings or to loans. It's difficult to find external investors. And it has a limited life. When the owner dies, the business dies unless there's additional paperwork filed. A partnership is a business owned by two or more people and operated for a profit. Generally, insurance brokers, real estate brokers, law offices, accountants organize themselves as a partnership. They're similar to a sole proprietorship. There are some strengths. The borrowing power is greater than for a sole proprietorship. That's because there's additional partners that you can draw equity from. And there's a greater distribution of work. So there's more people to spread the work around to. Weaknesses. Weaknesses. In a regular partnership, there is unlimited liability. It's difficult to liquidate or to transfer ownership. When one partner wants out, the others have to agree who can step in to purchase their shares. And the partnership dissolves when one partner dies. So here's another example of a problem. Suppose one partner dies. They leave their portion of the business to their children, but their children want no part of it. So then the other partner is forced to either buy them out or to sell entirely if they aren't able to buy them out. The third form of business organization we're going to look at is a corporation. A corporation is a separate legal entity created by law. They do have the legal powers of an individual. They can sue and be sued. They can make and be party to contracts. And they can purchase property. Ownership is represented through shares of stock that can be freely bought and sold. And the strengths. Limited liability. So, because the company itself can borrow money, the owners are not responsible if the company cannot repay its obligations. It's easy to grow. So there's greater access to capital. Now you have owner's equity. You have bank loans, you have private investors, you can sell shares of stock in the open market. It's easy to transfer ownership. And it has a perpetual life. So easy to transfer ownership. These shares of stock can be freely bought and sold amongst investors. And if an owner dies, their shares of stock pass to their beneficiary. Weaknesses. Higher taxation. Legally complex. You can't just slap a sign on the door and say you're open for business. You have to file paperwork. You have to work with your lawyers. It's expensive to start a corporation. There is greater regulations, especially if you're a public company. And there is less secrecy. There are different types of corporations. There's S corps and LLCs that allow taxation to be different. So with an S corp, small corporations are allowed to maintain limited liability, but they're taxed as a partnership. With a limited liability corporation, it's similar to a corporation where owners have limited liability, but the owners choose whether they can be taxed as a corporation or as a partnership. To become a public company, you first sell your stock on the open market through an initial public offering. Startup companies are usually financed through personal resources such as savings or home equity loans or credit cards. As the company grows, it may become successful enough to attract lending from banks, and it may even be large enough to attract funds through an IPO. So an IPO, the initial public offering of stock, allows new capital from new sources. It reduces the reliability on individual banks and venture capitalists. And it also allows founders and pre-IPO investors to get some of their money back, so they're able to cash in. Once a public company is public and they want to sell additional shares in the open market, that's called a seasoned equity offering, an SEO. Usually 1/3 of IPO issuers return to the market within 5 years. The majority of firms within the United States are organized as a sole proprietorship. 73% of firms in the U.S. are organized as sole proprietorship, but they only bring in 5% of all sales. Corporations make up 20% of all firms, and they bring 89% of sales dollars. Most large businesses are corporations, and that's because expanding companies will incorporate so that they can seek money from external investors whom they can provide limited liability. Corporations are organized in a hierarchy. Shareholders, the owners of the company, elect the boards of directors, who then hire the CEO, who hires the executive office members, who then hire the managers, who hire the employees. Most boards are classified. That means that only 1/3 stand for re-election every year. So when you're elected as a board member, you have a 3-year term. It takes 3 years to completely replace the entire boards of directors. Within the stockholders, there are many different types of stockholders. We'll cover them more in depth in a few minutes. But there are just the general shareholders, you and I, individual shareholders, who own just a few shares for their own personal financial planning. Institutional shareholders are investors who own stock on behalf of others. They're managing their wealth. They generally hold large blocks of stock, so it gives them more say-so in the day-to-day operations of a company. Block holders are those shareholders who own 5% or more within one company. And so they too have more say-so than just general shareholders. The goal of a manager, Financial markets are institutions and procedures that facilitate transactions in all types of financial claims. The purpose is to transfer savings from those with a surplus to those with a deficit. Generally, those considered savers are households, and borrowers are usually considered businesses. Some governments are borrowers and some are savers. The U.S. government is usually considered a borrower. So funds can be allocated between buyers and sellers in 3 different manners. First, we have a direct transfer, where businesses transact directly with the savers. Second is through an investment bank, where an investment banker, like an IPO or a seasoned equity offering or a debt placement, the company sells the security to an investment bank, which then sells the security to the investor. Third is through a financial intermediary. An example is an individual deposits money into a bank, they get a CD, the bank makes a commercial loan to the company. So you may ask, at what rate is this money transferred? How much does a lender receive by allowing someone else to access their money? We call the price, or the cost of debt, the interest rate, and the cost of equity is called the required return. There are three different ways that cost of money can be affected. First is fundamental factors. These include production opportunities, so the ability to turn capital into benefits, time preferences for consumption. People generally want now rather than later. Risk. More risk means more reward. Expected inflation. If there's an increase in inflation, we expect an increase in cost. Economic conditions can also affect the cost of money. So Federal Reserve policies, budget deficits and surpluses, the level of business activity, so are we in a recession or a boom, and international trade deficits and surpluses. And finally, international factors can affect the cost of money, things such as exchange rate risk and international country risk. To raise money, companies usually access either a financial institution or financial markets. Some types of financial institutions include commercial banks, investment banks, so investment bankers underwrite security offerings. Commercial banks are usually deposit-taking financial intermediaries. They take deposits from savers and lend to borrowers, and these include savings and loans, credit unions, commercial banks. Investment funds. So savers have an ownership interest in a pool of funds, and these include mutual funds, hedge funds, pension funds. And then the other alternative is a financial market. A market is a method of exchanging one asset for another asset. In the primary market, this is where securities are issued for the first time. So this is the only time that the company itself is actually involved in the transaction. So primary market transactions are initial public offerings or seasoned equity offerings. The issuer actually receives the proceeds from the sale of their securities. In the secondary market, previously owned securities are traded amongst investors. The existing owner sells to another party. The issuing firm does not receive proceeds and is not directly involved in the transaction. We can further classify markets and how they are organized. First, by location. So are these physical location exchanges, or are they grouped by computer and telephone networks? We can organize securities based on how orders are matched. So are these open outcry auctions? Are they organized through dealers or electronic communication networks? Physical location exchanges include things such as the New York Stock Exchange or the American Stock Exchange, and computer telephone networks are typically NASDAQ or government bond markets. Transactions can be completed in one of two ways, either market orders or limit orders. A market order means that the transaction should happen as quickly as possible at the current market price. A limit order says that the transaction should occur only in specific situations. For example, we only want to purchase the stock if the price drops below $50 in the next 2 hours. There are broker markets and dealer markets. Broker markets, these are where two sides of the transaction, the buyer and the seller, are brought together. So you can think of it as a real estate broker. Your real estate broker never actually owns the house that you're purchasing. They're just bringing the buyer and the seller together, and they receive a commission. That's the same way a broker market works. Party A sells his securities directly to Party B. The broker brings the parties together and receives a commission for doing so. Dealer markets, they actually keep an inventory of the stock, so they actually hold a position on one side or the other. They place bid-ask advertisements, so this is the prices at which they're willing to buy and sell. These dealers, the market makers, are linked together using a mass telecommunications network. A computerized quotation system keeps track of bid and ask prices. So the dealer makes money through the bid-ask spread, the difference between the bid and the ask price. Within a dealer market, buyers and sellers are never brought together. Essentially, two separate trades are made. Party A sells their security to dealer B. Party A sells their security to the dealer, and Party B buys their securities from the dealer. Electronic communications networks allow automated order matching. They match orders from buyers and sellers and automatically execute the transaction. It costs little. So there are three types of market transactions. The first two, and IPOs and SEOs, occur in the primary market. An IPO is where a stock is offered to the public for the first time. SEOs are where already public companies additional shares issue additional shares for the first time. The secondary market is where issued shares are traded amongst investors. The goal of the firm is to maximize shareholder wealth. So financial managers should only take actions that are expected to increase share price. Financial managers work for the shareholder. Our goal is not to maximize profit because profits are vague. Are we talking about long run or short run profits? And they can be subject to manipulation, even through legal ways. So you could simply switch your inventory methods. So you could switch from first in, first out to last in, first out. You could change your depreciation on your assets. All of these are legal ways to manipulate profits. The goal is to maximize shareholder wealth. Precisely, it's to maximize stock price because stock price is determined in financial markets where there are regulators and where there are large groups of buyers and sellers, and so it's less subject to managerial manipulation. Managers must balance this risk and return, and there are three factors that must be considered. Profit maximization may not lead to the highest possible share price because of timing, cash flows, and risk. Timing. People prefer now rather than later. Cash flows. Just because we make a profit, that doesn't mean that we have enough cash flows to pay money to shareholders. And risk. Profit maximization does not account for risk. Shareholders are risk averse. That means that they do not like risk and must be compensated for bearing it. So here's an example of timing. We have two investment opportunities, a rotor and a valve. The rotor has total earnings per share of $2.80, while the valve has total earnings per share of $3. If we look at the timing of these cash flows, however, we see that the rotor brings in 50% of their earnings per share in year one, so that you're recouping or you're gaining a lot of money early on in the project's life. Whereas the valve, even though it has a higher earnings per share collectively, you're not getting that money until much later in the investment's life. So I'm not saying that the valve is better or the rotor is better, but you can see how one may be preferred to the other despite the fact that it has lower total earnings. Later on in this semester, we'll cover techniques for determining exactly which one is better with some additional assumptions. Cash flows. Remember, we prefer more to less. But here's an example. We have a yacht. We purchased that yacht for $80,000. We sold it for $100,000. We paid the $80,000 for the yacht during the year, but at year end we still had not collected the $100,000 from the customer. So from an accounting viewpoint, we have revenue of $100,000 and we have cost of goods sold of $80,000. So we have profit of $20,000. From a financial viewpoint, we have cash inflow of 0 and outflow of $80,000. So our net cash flow is negative $80,000. So yes, technically we made a profit, but we don't have enough money in our bank account to pay electric bills. And we made a profit, but we may not have enough money in our account to pay dividends. So the shareholders may not receive any of this profit, even though we did technically make some. Additionally, there's the idea of risk. We prefer less risk to more. With profit maximization, you may choose a really risky action that actually does pay off. Profit maximization does not account for the large chance you took that it wouldn't pay off. It only says, yes, it did pay off and doesn't compensate you for that risk. So here's an example. We have a 50% chance of a $50 investment being worthless in 1 month or being worth $100 in 1 month. So the expected return on the asset, I'm not expecting you to be able to calculate expected return. This is just to show you an example. We have a 50% chance that we'll earn 0 and a 50% chance that we'll earn $100. So the expected return is $50. Alternatively, we have a $50 investment has a 50% probability of being worth 60 and a 50% probability of being worth 40. So it too has an expected return of $50. But any reasonable person can look at these and say that they don't have the same risk level. So even if we look at a simple form of risk, such as range, the range of payouts, here in option 1, we could either earn 100 or nothing. So our range is $100. In option 2, we could earn 60 or 40. So our range is $20. So option 2 is significantly less risky than option 1. And if we were to take option 1, we must be compensated for that additional risk. So if our goal is to maximize shareholders, what about the stakeholders? Those that have an economic link to the firm. They're affected by the actions of the business. A firm that has a stakeholder focus, they avoid actions that would be detrimental to stakeholders. The goal is not to maximize stakeholder well-being, but to preserve it. Such a view is considered socially responsible. So business ethics are the standards of conduct or moral judgment that apply to persons engaged in commerce. Not only does having good business ethics promote stakeholder loyalty and respect, build shareholder confidence, maintain a positive corporate image, but they can also reduce litigation and judgment costs, and this negative publicity that could be caused by having a poor ethics program can lead to other negative impacts on the firm. So violations of business ethics involve actions such as creative accounting, earnings management, misleading financial forecasts, insider trading, fraud, excessive executive compensation, options backdating, bribery, and kickbacks. Robert Cook is an ethicist, and he said that you should ask every question before taking the action. Does the action unfairly single out an individual or group? Does the action affect the morals or legal rights of any group? Does the action conform to accepted moral standards? Are there alternative courses of action that are less likely to cause actual or potential harm? So when you think of ethical companies, there are two that stand out, Google and Starbucks. So Google's model is don't be evil. It's not enough to run a successful business, but they want to make the world a better place. Starbucks' motto is to inspire and nurture the human spirit. They want Starbucks and everyone they touch to endure and thrive. Most people would agree that Google and Starbucks are ethical companies. I mean, there's a reason why you're willing to pay $5 or $6 for a cup of coffee. The coffee beans are grown in good ways. The people who pick the coffee beans are paid well. All the way up through the chain, they're ensuring that human rights are protected. And we know that as consumers, and we're willing to pay more for that. So a financial manager's job is to maximize shareholder wealth, but they're responsible for the overall financial health of the organization. They produce financial reports, direct investment activities, and develop strategies for meeting these goals. The size and the importance of the managerial finance function depends on the size of the firm. In small firms, this is generally performed by the accounting department, but as the firm grows, the finance function typically evolves into a separate department. These financial managers make decisions using marginal cost-benefit analysis. The field of finance is closely related to economics. Financial managers must understand the economic framework and be alert to consequences of varying levels of economic activity and changes in economic policy. So with this marginal cost-benefit analysis, it's the economic principle that states that financial decisions should be made and actions taken only when the added benefits exceed the added costs. And I'll show you an example. So here we're considering purchasing a new computer. With a new computer, we're going to have savings of $10,000. So it's going to reduce man hours or improve efficiencies enough to value it worth $10,000. The old computer is currently only providing us with $3,000 in benefits, so the marginal benefits in this case are $7,000. The new computer costs $8,000, but we can sell the old computer for $2,000, so the marginal costs are $6,000. So if we deduct the benefits from the cost, we have a net benefit of $1,000, which is positive, so we would choose to purchase a new computer. Finance and accounting activities are closely related and often overlap. One major difference between finance and accounting is that accountants usually use the accrual method, while in finance we focus on cash flows. Whether a firm earns a profit or experiences a loss, it must have sufficient cash flow to meet day-to-day obligations. So here's that yacht example we just looked at. We purchased a yacht for $80,000, sold it for $100,000, but we hadn't collected the money yet. So an accountant says we made profit of $20,000, but a financial manager would say we have negative cash flow of $80,000. Yes, technically we made a profit, but we may not have enough cash flow to pay our bills. Finance and accounting also differs with respect to decision making. Accountants devote most of their attention to the collection and presentation of data, while financial managers make decisions on the basis of that data. We as individuals, we use the cash flow method. So this individual, he brought in $4,620, but he spent $4,835. So he spent $215 more than he made. Individuals don't use accrual concepts. They rely solely on cash flows to measure their financial outcomes. The final topic within this chapter is corporate governance. Corporate governance refers to the rules, processes, and laws by which companies are operated, controlled, and regulated. It defines the rights and responsibilities of corporate participants. Corporate governance is influenced by internal factors and external factors. Internal factors include shareholders, boards of directors, managers, while external factors include customers, suppliers, competitors, government regulations, economic conditions. So we already talked about the two types of investors. There's individual investors who own shares of stock for their own personal investment goals, while institutional shareholders are investment professionals, such as banks, who hold large quantities of stock on behalf of others. A third type is block holders. So these are investors who own 5% or more of a company's stock. Unlike individual investors, institutional shareholders and block holders often monitor and directly influence a firm's corporate governance. They're able to exert pressure on management to perform and communicate their concerns with the board of directors. Individual shareholders don't have this ability. External factors. First, we talked about government regulations. So we already looked at SEC's EDGAR website, and we saw all the filings that public companies were required to report. I can't imagine that they would be cheap, and they were very costly in time as well. During the recent decade, corporate governance has received increased attention due to scandals. In response, the Sarbanes-Oxley Act of 2002 was passed. This mandates financial disclosures and intends to eliminate false financial disclosures and undisclosed conflicts of interest. SOX was fully adopted in 2006. If you read proxy statements prior to then, you will notice that some areas are drastically different. Now companies are required to report transactions with related persons. So this is examples like, I'm the CEO and my son-in-law mows the grass. Or, I'm an executive officer and I hired my sister's interior design firm to come in and redecorate corporate headquarters. So there's not anything necessarily wrong with them, but they have to be told to everyone. So managers are hired to work for the shareholders, the owners. So there's a separation of ownership and control. Agents may not always act in the best interest of the shareholders or the principals. In this arrangement, where someone acts on the behalf of another, an agent acts on the behalf of a principal, is known as the principal-agent relationship. And problems can arise when managers place personal goals ahead of those goals of the shareholders, and these are referred to as agency problems. These agency problems arise due to reasons associated with personal wealth, job security, and fringe benefits. Examples, lost opportunities, or failing to make appropriate investment decisions. So you as a manager may choose not to accept a new project that you know will have positive economic value added because it may eliminate your job. Fringe benefits. So you as an executive officer may say, yes, we definitely need to have our corporate retreat in Maui this year and we need to fly there on the corporate jet. Even though shareholders may be better suited for you to have a more reasonable corporate retreat. Other activities include fraudulent activity. Agency problems arise when managers deviate from the goal of maximizing shareholder wealth. And these agency problems result in agency costs. Agency costs are costs borne by shareholders and represent a loss of shareholder wealth. So in addition to the roles played by corporate boards, institutional investors, government regulations, corporate governance can be strengthened by ensuring that managers' interests are aligned with those of shareholders. To do so, we can structure managerial compensation with firm performance. Two main plans are incentive plans and performance plans. Incentive plans are where managerial compensation plans tie compensation to share price. So an example is stock options. Incentive plans are superior to performance plans because remember we talked about how share price is determined in an efficient market where there are regulators, buyers, and sellers. So it's not easy to manipulate share price. Performance plans tie managerial compensation to measures such as earnings per share or the growth in earnings per share. So, for example, if earnings per share increases by 10%, we will award you performance shares or a cash bonus. But it's not true that the highest paid CEOs are necessarily the best performing. So we have a survey from Forbes. It lists the three best CEOs and the three highest paid CEOs. The best CEO, according to Forbes, is the CEO of Priceline. He was paid $7.5 million. But he was not the highest paid. He was 135th in line. The highest paid CEO is not the best performing. He was 90th on the list of best performing CEOs. So just because they're well paid doesn't mean that they're going to perform well. If internal corporate governance structures are not able to keep agency problems in check, then there is a significant chance that rival managers will try to gain control of the firm. This threat of takeover, where an external being believes that they can enhance firm value by restructuring management, operations, and financing, can be a strong source of external corporate governance. That's it for Chapter 1. I apologize for the first recording that didn't turn out so well. I did extend the homework by a couple of days.